Okay, we're going to get started. Welcome to our webinar, second in our series, Community Choice Aggregation Expansion in California and its relation to investor-owned utility procurement. We do try to come up with catchy titles, so we hope you like that one. Thank you all for being here. I hope you're all enjoying your summer. Today, we are going to be I want to first give a little bit of an overview and housekeeping. Just so folks know, the webinar is being recorded. If you have questions, if you're having any trouble hearing or any other issues, you can type questions or those issues into the control panel at any time. In terms of the Q&A, that'll be at the final 15 or 20 minutes of the webinar. And I just want to note that we do have some handouts in your webinar, GoToWebinar interface screen there. You should see some handouts. One is the report itself that this webinar is all about, which is the same name as the title of this webinar. The speaker bios for today. And another one that I just attached this morning, which was a relevant announcement back at the end of June about this California Public Utilities Commission proceeding that's been opened up on the PCIA issue that we're going to be talking about today. So your webinar jockeys today, myself, Woody Hastings, Renewable Energy Manager with the Center for Climate Protection, and Ross Markey behind the scenes, helping with the technology here, and he'll be helping with the questions. So that's us. Our presenters today are June Brashears, the lead author of the paper, and an independent energy policy analyst, and Neil Reardon, the Regulatory Affairs Manager at Sonoma Clean Power. Just a little bit about the Center for Climate Protection and our work. We do most of our work relative to community choice is embodied in a website, Clean Power Exchange, cleanpowerexchange.org. At that website, there's all kinds of information, resources, and tools for folks interested in community choice. We have a unique interactive map that has drill-down information on every city and county in the state of California, a bi-weekly e-news that's divvied up geographically, and there's also sort of a statewide e-news. And we have a policy page where things like these regulatory matters are also posted. We host an annual Business of Local Energy Symposium, and we kind of think of these webinars as a continuation of the conversations that start at that symposium. And so, you know, a lot of the issues we'll be covering here in this webinar series will be sort of continuations of those wonderful conversations that happen at the symposium. We have landed on sort of a time of the month for these webinars, second Wednesdays at noon, so you might want to just sort of jot that down in your calendar, and we will be announcing our next webinar at the end of this one. It's going to be on September 20th. We do put together white papers and reports like the one we're talking about today, and also want to announce a new Clean Power Exchange forum where this topic and others can be discussed. The URL for that is right there at the bottom, and so we invite folks to continue the conversation we are having today in that forum. I have posted the connection to the proceeding at the CPUC at that forum, and we'll probably use some of the questions that are raised today on today's webinar. We'll use those questions in that forum to kick things off, because we're just getting that started. So with that, that's just our little Center for Climate Protection and Clean Power Exchange commercial, if you will. So I just want to now turn it over to our first presenter, June Brashears, who will take it from here.
Hi, thank you. I'm happy to be here to share the information from the report. So community choice aggregation or community choice energy, you hear both terms, and I may use those terms interchangeably as I'm speaking, or I might say community choice agencies or CCAs. All the time I'm referring to the same thing, community choice aggregation. And this report was done for the Center for Climate Protection, as they're interested in getting a forecast about the likely expansion of community choice energy, and they were wanting to quantify that to see what it's going to mean for how much energy we can expect is going to be departing from the investor-owned utilities and being procured by the community choice agencies. So this report also considers how the investor-owned utilities' historical role in the procurement of power and the related costs impact community choice aggregation, its expansion. So as we'll go to the next slide here, we get on this clicker here. Okay, so this map here is the one Woody, I think, referred to. It's on the Clean Power Exchange website, and it's regularly updated. And if you go to that website, you can actually click around on the map. It's interactive, and you click on any area, and you'll get a pop-up. And that'll give you an update of what's happening in that county. It even includes all the cities. And it's got great information on the status of community choice. And this was utilized in our forecast for the report. We were trying to determine what progress was being made in the various communities in order to forecast what communities were likely to start a community choice agency over the next few years. So this map, you can see the green areas and the green striped areas indicate where there are community choice programs in existence. And there currently are 8 operational community choice programs, and more than 300 California communities are in the process of exploring or pursuing community choice energy programs. And this map, along with consulting with staff and other consultants for emerging community choice agencies, that was the source for our forecast of where and when we can expect new community choice service to be established. And the next slide shows where we do expect new community choice agencies to begin over the next few years and when. And overall, we found significant growth in community choice energy is anticipated over the next few years, with 2018 likely to see the largest increase of community choice energy development, with potentially more than 6 new community choice entities involving 11 counties. So based on these projections of where and when community choice agencies will be expanding, we then calculated the amount of energy procurement in terms of gigawatt hours that will be shifting from the investor-owned utilities over to the procurement responsibility of community choice agencies. And on the next slide, we see this chart that shows the transition of gigawatt hours of electric load shifting from the investor-owned utilities to the CCAs in California. And you can see the dark blue at the bottom is the existing community choice agencies. It barely shows up in 2014, and then it's growing to the current load for 2017. That includes the 8 community choice agencies we have now. And it's still not much now in proportion to the whole state. But where you see there's a real dramatic change is in the communities projected to begin community choice energy, shown by that green area of new CCAs coming online. That shoots up over 2018, 2019, and 2020. And so by 2020, you see that community choice energy providers will be the dominant procurers of electric generation in the CCA eligible areas in the investor-owned utilities service territories. So by 2020, CCAs would be providing over 116,000 gigawatt hours, and the investor-owned utilities would be then providing under 85,000 gigawatt hours of electricity. So to actually determine this, the source information we use was for the recently launched community choice agencies. We used the load data in their implementation plans. And then for the longer existing community choice agencies, we used Pacific Gas and Electric's Energy Resource and Recovery Account load forecast for 2017. And for the other new CCAs, we gathered data from the California Energy Commission's online database for electricity consumption by county, and the California Energy Commission's forecast growth rate was used to project those forward in time. And then for small areas like Lancaster that has their own community choice program, we figured their load based on their percentage of Los Angeles County, what their population is as a percent of that. And we're pretty conservative in projecting this transition of load. For new CCAs, we figured the first year we reduced the load by 50%, figuring they'd have phased roll-ins of customers. And then we also reduced the load projections by another 25%, accounting for about 10% direct access customers and 10 to 15% of a out rate. And so what you can see overall, the summation here is that there's significantly less electricity that needs to be procured by the IOUs, and so, or the investor-owned utilities. I may say IOUs, and that's for investor-owned utilities throughout the report. And that's our independent forecast, and we then looked at what are the investor-owned utilities thinking is going to happen. And here's Pacific Gas and Electric, PG&E's projections. And what they're showing here, they're expecting the combined departing load for direct access and community choice customers is shown there. And on the left-hand bar for 2017, they don't mark the year, but it's the farthest left bar. That's showing about 13 terawatt hours. That's the same as 13,000 gigawatt hours. They're doing theirs in terawatts. So this is also showing it growing over the years to almost 35 terawatt hours by 2030 for combined CCA and direct access departing load. And for 2017 or for 2020, their projections for their CCA and direct access departing load is about 23 gigawatt hours. 23,000 gigawatt hours. And that compares to our independent projections. We projected for 2020, just for CCAs, the departing load would be 44,000 gigawatt hours. But either way, whether even with PG&E's projections or our independent projections, this is a significant amount of departing load for CCAs that's going to need to be incorporated into planning and to be dealt with for a smooth transition. What I'm showing here on the next chart, this shows in the green bar on the left our report's estimate of CCA load for 2017. The blue bar on the right shows how PG&E is forecasting CCA departing load in their Electric Resource and Recovery account for 2017. Now the ERRA is their forecast of their electric procurement costs and electricity sales, and it's the proceeding that sets the rates, including what CCA customers must pay, a lot of the fees that we have to pay as well. So what this shows is that PG&E, the difference is there because PG&E did not include new community choice programs that we were quite sure were going to launch in 2017, but they did not include this in their ERRAs until a new CCA is actually enrolling customers or has filed with the California Public Utilities Commission or California Energy Commission a load forecast for the purpose on taking on resource adequacy load requirements, or if the CCA has filed a binding notice of intent. And basically, this is that the investor-owned utilities are responsible for procuring electricity right up until legal authority is actually transferred to the community choice agency for those CCA customers. And the investor-owned utilities really should be adjusting their procurement projections to incorporate expected expansion of CCAs. And so this is a recommendation here, is that we need to be having better planning earlier as far as the impact of the procurement planning and the growth of CCA expansion. And right now, the California Electric Planning and Procurement is regulated by the California Public Utilities Commission Integrated Resource Plan and Long-Term Procurement Plan. That's this IRP-LTPP proceeding. And the IRP-LTPP is based on the California Energy Commission's Integrated Energy Policy Report. And up till now, the present time, the IERP load forecast and all these resulting procurement decisions by the investor-owned utilities have been underestimating the CCA expansion and departing load. And they tend to always overestimate utility resource needs as well. And this is causing over-procurement is what we're looking at now. And because this over-procurement generally causes increased costs for all electric ratepayers, we do have consumer advocates that have long been trying to fight this over-procurement in the proceedings, but nevertheless, the results have basically been heavily biased towards over-procurement. And so, up until this part of the report, we've really been looking at the growth. We've covered the growth of CCA expansion that's anticipated. And now we're going to kind of shift over to some of the issues that stem from the past decisions that have already taken place around procurement and the impact that's had on that's having now on community choice energy through what's been called the exit fee. So, which is the power charge indifference adjustment. And the stated intent of this power charge indifference adjustment is to make the ratepayers who are staying with the investor-owned utilities indifferent to the fact that other ratepayers are departing to join community choice agencies. So I'm just going to go by the acronym PCIA. It's a long term. So this PCIA is really, they say the intent is to be fair and to protect the bundled investor-owned utility ratepayers from being impacted by any costs that of excess capacity that the IOU had procured on behalf of these customers that have left to go to the community choice agency. And this is because we have a state law that when the investor-owned utility buys electricity contracts, long-term contracts into future years on behalf of ratepayers, and then you have some of that load departing to a CCA, the investor-owned utility is then able to charge those CCA customers for this supposed loss of if the IOU can't sell that power back at the price that they paid for it, the CCA customers have to be responsible for that difference. And that's how the price is figured. It's the investor-owned utility's total portfolio cost minus what is the market value. And there's some controversy about what really is the value of that portfolio and the market value. And this PCI is also based on the figures. It isn't done after the reality of what the energy sold for, but it's on a forecast. And each year they reset the forecast and they never true up. If things turn out different than the forecast, that may mean cost shifted and different things were out of alignment, but it's not trued up. They just start again the next year. And these are all sort of part of the recognized problems of the PCIA. You have the investor-owned utilities and the community choice agencies and customers all recognizing that the PCIA is flawed. You've got a lot of different arguments. The forecasted figures for the PCA is based on this market price. It says market price B. It means market price benchmark, or MPB. And there's a lot of different reasons of why that's contested about whether that's a proper valuation. Most folks agree it's not, but for different reasons. And when those forecasts don't really come true about what the prices were, that can shift costs. So CCA customers could pay a lot more or a lot less than what they were expected to be their fair share. The prices are changing. The PCI has been very volatile, and I think Neil may speak more about some of these issues. But basically, we really need a different system, and one of the big problems has been lack of transparency. It's been very opaque because the investor and utilities electric contracts are confidential. So a big proposal is to actually allow community choice agencies to have reviewing representatives that can, through a non-disclosure agreement, get access to the confidential data so that they can check the prices and how the PCI is allocated, just to make sure it's accurate, and also so that we have a better ability to forecast what the market, the electric changes in electricity market, how those could impact ratepayers or customers, CCA customers, in future years. And there were a number of PCIA workshops that the California Public Utilities Commission convened from last year to early this year, and it became clear in that one of these recommendations for getting the community choice agencies access to this data was one of the items discussed, but it wasn't able to get agreement on that, so we're hoping to get that through other proceedings at the CPUC, perhaps through the ERA process and others. The other discussion that happened a lot was about the problem how currently the investor and utilities really don't have an incentive to reduce the costs of their procurement contracts, because they're able to just pass on the costs of approved contracts to the retail customers. They recover that from CCA customers through the the PCIA. So this is a big area that needs to be dealt with. And overall, we need a new alternative to the PCIA for certainty for CCA customers and bundled ratepayers, and a time limit on the fee is what we're looking for. But to get this, we're very much likely going to need the California Public Utilities Commission to do a proceeding that would really have a transparent and holistic look at reforming the structure and nature of the PCIA. And this has been long asked for. Good news, this is done at the end of June 29th. The Public Utilities Commission did open a proceeding, and we've got the way, if you want to stay up to date and get the updates on that, and Neil may talk about this more, about what's happening there, that we've had a lot of parties agreeing that the PCIA is flawed, but this is where we've really got to work out what's a fair way to go forward about the legacy costs of over procurement and how we're going to have a good, transparent, and equitable process going forward. So that's basically where I'll wrap up for now, and we'll have some time for questions. I want to get to that and hear Neil's comments, and I am available afterwards if folks want to follow up on anything that didn't get covered.
Well, thanks very much, June. That was a great webinar overview of your paper, which itself is sort of an overview of this whole huge, enormous issue. For folks that joined late, my name is Woody Hastings. I'm your webinar host today, and I just want to let folks know, especially the ones that may have joined late, I mentioned earlier, the full report, free report, is available for download in a handouts section that you should see on your interface screen there. So be sure to get that. It's also at the Clean Power Exchange and Center for Climate Protection websites. So without any further ado, and to stay on time, I want to introduce our second presenter, Neil Reardon, Regulatory Affairs Manager for Sonoma Clean Power, to offer a community choice agency perspective on the procurement, their procurement, IOU procurement, and the PCIA. So Neil, if you're still there, please, you should have control of the screen. Take it away, Neil.
Great, thanks very much, Woody. And June, that was an excellent summary. I can't remember seeing all those complex issues sort of teed up that well before, so thank you. I'm just going to give a little bit of background on the differences in procurement between CCAs and utilities, talk a little bit about CCA programs, and then come back to the main issue at hand, really, of exit fees, which June teed up. So we saw the map, which I really think captures sort of the present and future of CCA development. This is just a list and some data of the operating CCAs. And I'll just point you to a few things here. You know, one, first of all, is you see the minimum RPS, the minimum renewable portfolio standard content of energy as a weighted average across CCAs is 48% for 2017. The law requires 25% by the end of 2016, so collectively we have almost double the amount of renewables that we're required to have. You also see a very low use of unbundled RECs. I won't get into the details unless there's a question at the end, but that's a more cost-effective way to meet renewable portfolio standards than building new generation within the state that's interconnected to California's grid. To date, CCAs have spent about $2 billion in construction, so we're talking about a huge amount of projects really spread across the state. The majority of the spending has been on projects with, we call them PLAs, project labor agreements, and this is a very rapid transformation in the market. You know, I was at a conference with some developers 6 months ago, and they were, you know, half the guys were grumbling that business wasn't good and utilities weren't buying anymore. And it seemed like the other half were really excited about the CCA opportunity and doing business there. We are able to do this relatively quickly, though it still takes time to have a diverse portfolio. I mean, in our case, I think it was 3 months after we launched, we signed the first deal to build a new project. But then that project, you know, could take a year or two to come online and be interconnected and operating. And then at that point, that's almost all of your portfolio. So if you sign a solar deal first, you're going to be heavily weighted towards solar until you're able to sign some deals for other resources to kind of round out the portfolio. A snapshot of procurement to date across different CCAs is here, and it's just really the takeaway is there's a huge range of resource types, sizes, locations, and contract lengths. So it's really, I think, collectively, the CCAs do have a very diverse portfolio. And, you know, while Sonoma Clean Power and several operating CCAs do favor generation in their county and sort of keep an eye for creating and sustaining local jobs, you can see from the location column here that these projects are really going up across the state and, in fact, providing benefits for communities that haven't formed CCAs. The UCLA Luskin Center did a paper recently which looked at the amount of particulate pollutant coming out of gas plants, a lot of these in low-income areas, and essentially found that because CCAs are launching and buying more renewables throughout the state, that reduces the demand for natural gas and reduces not just the GHGs, but these criteria pollutants that make people very ill in those local areas. So it's nice to see benefits not just within the CCA territories, but spreading statewide. And of course, you know, we talk a lot about RPS and renewables, but at the end of the day, it's really about greenhouse gases. Right now, Northern California's CCA's average GHG emissions rate is about 44% lower than PG&E's and 60-something% lower than SCE's. As probably most of you know, CCAs are governed by public boards. We just had our board meeting this morning with good participation from, you know, a variety of stakeholders and customers. And really, in going back to procurement, a critical advantage that we have is a lower cost of capital. I mean, it's the way I think of it. You know, if you get a bond from a government, it pays a lower rate because it's backed by that government and has less risk than if you get a bond from a private company. And that same cost of capital advantage translates over into the procurement world. Now, granted, in the beginning, we had to educate developers about the CCA business model and how we're governed and how we're operate and show them that we're here to stay. But I think now that the market is kind of savvy to the fact that we are the future of procurement, these deals are happening much more quickly, and we've been able to do them at a very competitive cost. And, kind of more holistically, talking about GHGs, another critical strategic advantage we have is that closeness with our community. That allows us to work with other local government agencies to coordinate on things like land use planning, transportation, permitting, and energy, and to kind of take a holistic view of the picture. And I think it's not that a utility couldn't do that or they should be doing that, but imagine from PG&E's perspective, trying to go out and coordinate and understand with local government agencies across all of Northern California. It's just not feasible to really imagine that. So along those lines, a little bit about our program. So we've focused heavily on electric vehicles, and a lot of the reason behind that is Sonoma and now Mendocino are very rural counties. So a huge part of our GHGs come from the transportation sector. So for us, that's a huge opportunity to reduce GHGs and also to investigate really innovative things like aggregated discharging or coordinated timing, so that, the idea is to envision a day in the future when, if there's a large demand for energy in a heat wave, we don't have to fire up that natural gas plant. Instead, we can stop charging cars or discharge batteries to meet that same need instead. And a thing which has really made it fun to work here at Sonoma Clean Power is how quickly we can roll out programs. I mean, we can go from a crazy idea to a real program that's generating results in just a few months' time. And a lot of that is because of our size. We're smaller, we're nimble, but at the same time, we're large enough that this is not just a laboratory. This is a real case, and we can provide impacts and then inform policies that could be rolled out statewide. So now back to the elephant in the room, the PCIA. I put together just a sample chart. So this is for a residential customer who left PG&E service in 2013. In that year, you see their PCIA would be 0.006 dollars per kilowatt hour. Maybe a better way to say that is $6 a megawatt hour. And by 2017, that's gone up to $30 a megawatt hour. I mean, this is a massive increase. And to put that $30 figure in perspective, what our residential customers spend for the generation is about $60-something a megawatt hour. So really, a third of what they're spending is for the right to not be a PG&E customer and to cover those sunk costs that PG&E made on their behalf. And I think June captured it really well. There's sort of this willful blind spot where the utilities will continue to procure for customers, even if they're in a territory that's evaluating CCA feasibility and forming a joint powers authority and hiring staff. They would still continue to sign 20 or 25-year deals up until the day before the CCA actually launches. And that just sets the stage for the situation we're in now of a huge amount of over-procurement. Now, another theme that June really touched on well was there's a lack of incentive for the utilities to reduce costs because all the costs flow directly through to shareholders. And this is a result of decoupling. And the idea of decoupling was that for-profit utilities shouldn't earn a shareholder return for every kilowatt hour of energy they sell, because then that presents a conflict of trying to get them to roll out energy efficiency programs or reduce greenhouse gases. So the answer to that was decoupling, which means that they do not have an incentive to sell more energy, but they also have no incentive to reduce costs. And I don't think it means they're bad people or they're doing a bad job. It's just a structural problem. I imagine if you went out to a restaurant and were waiting in line and took a long time to get your table, and then the manager came out and said, your meal's going to be on the house. If you're me, you're probably going to order the lobster and maybe a glass of wine and dessert to go with it. So I think it's a problem of misaligned incentives, and that gets us in this situation of double procurement. I think you saw the table in June's paper outlines that in PG&E's territory, they have 140% of the resources they need to keep the lights on 20 years into the future. So in other words, they could not sign any other contracts for the next 20 years, and they would still have 40% more than they need to meet the peak hour on the peak day. Now, obviously, if the shareholders were on the hook for the cost of that procurement, I think they'd be much more prudent in what they would invest in. Another critical issue which is going to come up in the commission rulemaking is the avoidability of costs. Right now, all the costs the utilities incur are passed through to the customer without any glance at whether there was anything the utility could do to limit or reduce that cost. I mean, we've seen cases of developers failing to meet guidelines. The project is not online, it's not delivering, it's having technology issues, and instead of just canceling the contract, you know, as described as a legal right under those terms, we've seen the utilities petition to make amendments to the contract and extend them and sort of throw a lifeline to contracts which are way out of market and aren't meeting their goalposts. And I think that just really exacerbates this issue and contributes to the volatile increases in the PCIA. The last critical issue I'll talk about before we move on is, as it is right now, CCA employees have no ability to forecast the PCIA. So what that means is we don't know until a few months in advance if our customers' bills are going to go up significantly. And that makes it really hard to plan and to budget, and also to protect our customers from bill increases. I mean, you especially imagine someone on a low or fixed income, you know, having their generation rate or their utility bill double from December to January is really hard to handle and hard to bounce back from. So I think that's really the most critical impact is on our customers and those on a fixed income. For us as an agency, it makes it hard to budget and to plan. We don't know how much wiggle room we'll have or how much we'll have to contribute to reserves or to launch things like a new electric vehicle program, because we have this kind of volatile bill that changes every year that we can't predict or control. CalCCA, the CCA Trade Association, filed a petition with the Commission to modify those rules, and essentially to say that someone like myself who doesn't work in procurement, signs a non-disclosure agreement approved by the Commission, could look at what utility costs are coming up in the next few years, and then could plan our rates and our budget around that to better protect our customers. So, moving on to the future. As June said, the CPUC is open to rulemaking, which is fantastic news, and really that's them signaling that this is an important issue. It's affecting a larger and larger share of the market, because remember, it doesn't just affect CCA customers, it affects utility customers as well. So we were very glad to see them taking a serious look at this, and also, in comments, commissioners openly acknowledged and questioned whether for-profit utilities that also earn shareholder returns selling gas can be expected to support things like an evolution to electrification of the transportation sector. It's hard to imagine they can do that given the just inherent conflict of interest. And so I see a great potential there for CCAs. And I'll just wrap up with, I think the key point is that resolving these exit fees is really the most critical step. And again, this isn't just about CCAs or their customers, but this also benefits utility customers because they're subject to the same uncertainty. And I think that's something that utilities and CCAs have agreed on, is that the current mechanism of the PCIA is broken, and it subjects both customers to volatile flows. We haven't seen the utility customers having to write a check in the direction of our customers yet, but the idea is both sets of customers are subject to this volatility. So now that the rulemaking is underway, multiple parties submitted comments. Those just came in on July 31st, and the next step is that the Commission will determine exactly what is in scope for this rulemaking. They're targeting a 2-year process, as they do for rulemakings. So it would likely conclude about the end of 2019. And if I were to pick a date for when any new framework would roll out, I'd say beginning of 2021. That also starts a new RPS compliance period and would give a year for transition and implementation of a new PCIA framework. So with that, I will open it up to questions. Thank you very much.
All right. Well, thank you so much, Neil. Fantastic presentation. Again, this is Woody Hastings here, and Renewable Energy Manager for Center for Climate Protection. And we will go to our Q&A session here. Just I'll say a few things about how we're doing this. Hopefully folks have questions, maybe have been typing some of those in. The way we're going to do this is we've got about 100 people on the webinar today, so we're not going to be opening up the microphone or anything like that. What we're doing is we've got Ross Markey, our renewable energy analyst and webinar co-host, helping with the questions. So please type your questions into that little question box interface. And presenters, if you could please keep your answers as brief as possible so that we can get to as many questions as possible. So with that, Ross, do we have some questions coming in?
Yeah, Woody, we do have a few questions, and I do see a couple more coming in too, so thank you. But why don't we start with a question for June. This question is from Barry Vesser, and he asks, do you have an estimate of the cost to California customers of investor-owned utilities over procured power based on your calculations?
I don't have that exact number. You know, there's been so much, and then we've been paying for it through the PCIA, and there's so many different aspects to that. I don't have a simple. We didn't actually look at cost. We were looking at quantity of gigawatt hours and what was likely to shift, and then the process for dealing with that over procurement through the PCIA. But I didn't get an actual number on what that costs ratepayers. So if I'm understanding the question correctly, and I don't know if Neil, you have a comment on that, on any estimates of cost around that.
I can just offer, I know Clean Power SF put together an estimate, and it was around 50%.
All right, Ross, what else do we have?
All right, so now it looks like we have a question for Neil here, and this is from Sean Kennedy. And Sean asks, are you sure about the CCAs having a lower cost of capital? I was under the impression that as separate entities, CCAs often start life with no credit rating, resulting in high costs of capital.
Yeah, that is correct that we start with no credit rating, and you know, even today that's something we're working on, but we do not have a credit rating. However, we also don't have to provide shareholder returns, so that keeps our average cost of capital. I shouldn't divulge numbers because they were given to me in a private conversation with an IOU, but what they showed me for their internal weighted average cost of capital was a full percentage point higher than what we use.
Okay, thank you, Neil. Now, we've had a couple more questions kind of fired in here, and they weren't addressed at either June or Neil. So if either of you feel more comfortable answering these guys, please go ahead. So our next question is from Daniela, and Daniela asks, if there was an incentive for investor-owned utilities to reduce procurement costs, is there a risk of IOUs rates being lower than CCA rates, effectively undermining CCA's competitive price advantage and threatening CCA programs' viability?
Well, I'll start with saying that that threat is certainly there, but you know, we welcome competition, and I think at the end of the day, the customer benefits. So, as a statewide policy level, I'm not concerned about that, and I'm confident that we could compete. In fact, there was a period in a certain type of contracts where PG&E was given an incentive. They were told, however you can renegotiate these qualifying facility contracts, your shareholders keep 10% of the savings. And that was very effective. That was an excellent motivator, and they were able to reduce costs significantly.
Yeah, and I would just say I'd like to see a combination of carrots and sticks as far as reducing those costs. Yeah, I think that the whole purpose of community choice energy is to benefit the population in general, and they're up for competing, and that if we, all ratepayers get a benefit, and it makes overall the bundled customers also have lower rates. I mean, we're all for improving the situation for ratepayers across the board. So that's not really a conflict of interest, because in every community choice agencies, the members on the boards have people that they're representing in their jurisdictions as local elected officials, that some of the residents, constituents are IOU, stay with the IOU for the procurement, and some are community choice agency customers. So we really, the overall boards and intent of community choice is to really benefit all ratepayers in one way or another.
Great, thank you. Okay, so our next question comes from Daniel. How can the PCIA rely on forecasted energy market prices and not have a true-up? Does that not incent a lowball estimate of what the power will be sold for? Is this audited?
That's an excellent question. So the estimate of what the power is worth is something that's determined by the CPUC, and they essentially condoned a formula for evaluating what the value of that energy and capacity is. And that was done, I think, in the early 2000s in the context of customers leaving for DA service. But I agree that not having a true-up, then just it kind of willfully subjects both classes of customer to risk, because if the number isn't right and you never look back and adjust it, then how can you know that you're being equitable? In terms of being audited, I don't know. The Office of Ratepayer Advocates at the CPUC has the authority and responsibility to do that. Because I can't see those figures, I can't be a part of that conversation or really know what's happening.
Yep, I think Neil covered it well. That's what I was going to say as well. I mean, that's why it's such a, when people really realize that, they say, well, that's outrageous. And it is part of the problems. And then there's also this question of, if we did have to adjust after the fact, then there'll be another whole set of volatile additional costs or credits that would come into play. So we really do need a better formula than just even having a true-up. Having a true-up would not solve the problems of the PCIA, but it does show what a strange system we have currently.
Great, thank you both. Looks like our next question is from Kirk, who's down in Orange County. And Kirk says that they have limited space for clean energy expansion due to land cost. What do you suggest to promote CCA in a dense region like this? Commercial and private rooftop solar?
That's a great question, and that's actually something which we deal with in Sonoma and Mendocino. We have the land, but permitting is a challenge. And so I think rooftop solar on all sorts of roofs is a great option. We have a feed-in tariff where we will pay developers more if they can develop projects within our service territory. So that's a kind of a carrot that you could dangle out there and see what creative responses you get from the market. But also, there's no hard and fast rule that your generation has to come from within your city or county. So you could look more broadly as well.
Yeah, and I would just add that the benefits of the community choice program are somewhat on getting local renewables, but there are also many other ways that the community choice program could benefit the local economy and deal with greenhouse gases, as far as fuel switching programs, the transportation programs. So I think would be really of interest in Orange County to have the electrification of transportation augmented there. And then as far as just advancing that development of local renewables, there can be programs like the feed-in tariff that many community choice programs have, and community choice programs are also exploring how to do programs such as on-bill financing of rooftop solar and other ways that there could be other innovative programs that community choice agencies can do to augment the deployment of rooftop solar, as well as looking at other programs that outside of development of local renewables that I think Orange County would be really interested in and benefit from.
Okay, thank you, June and Neil. Our next question comes from Trevor, and he asks, with the rise of CCA procurement, it seems that the IOUs could be long on their RPS requirement, renewable portfolio standard requirement. Do you anticipate CCAs taking over existing long-term IOU renewable energy contracts rather than procuring new renewables?
Excellent question, and that's something which we're absolutely going to discuss in the rulemaking. I mean, just stepping back, it's sort of a ridiculous setup where you have the utility has more renewables than they need, and you're right. Every time CCAs form and leave, it boosts up the utility's RPS content. So in PG&E's case, if 50% of their load departs, they're going to be at 43% RPS with what they've already signed in 3 years. So if that 50% of their load departs, well, now they're at 86% RPS. And I think they and we absolutely need to have the conversation of, what's the mechanism for them to sell or auction off either full contracts or sort of allocations of contracts, because this is just, it's harmful to both ratepayers.
Yeah, and I think that they have the procurement contracts they already have that they're long on, and then we're also wanting to make sure they don't add in additional renewable power at high rates until we get this sorted out, because there's other renewable auction mechanism coming up and other planning that we need to be involved in to make sure they're not taking on even more in the short term.
Okay. Thank you both. And looks like we have another question that just came in from Ariana in Santa Monica. What are your thoughts regarding the power marketer model versus a portfolio asset manager, particularly in regard to mitigating risk and setting rates?
That's really not my area of expertise, but on the policy side, I can just offer that having a diverse portfolio is something that regulators are looking at very closely. They no longer want everyone to go out and buy as much solar as they can, because it creates grid conditions where there's this huge amount of supply and often negative pricing during the middle of the day because there's so much solar and there's nowhere to use it. So I think it would be prudent to certainly look at having a portfolio that comes close to matching your customer's demand.
Okay,
yeah, and I don't really have anything to add on that. I think that's a good answer.
Okay. Okay, so we had a question regarding the source of Neil's slide on CCA procurement to date, and the question was, can that be found on Cal CCA's site?
It was a Cal CCA slide. I took it from the Cal CCA comments on the CPUC's en banc on retail choice, which was held on February 1st.
We're talking about this one?
Or no, I was referring to the green one with the list of...
Okay. That one.
Correct. Yeah, both of those are Cal CCA materials, so I'll ask to have those posted on the Cal CCA website.
Okay. Great. So let's see. We had another question come in. Let's see. CCAs benefit from the all-time low pricing in solar and wind contracts today. What is to prevent deflection of customers back to IOUs once the legacy PPAs signed by the IOUs at now out-of-market prices roll off?
Yeah, there's nothing to stop that. And I don't think there should be an assumption that CCAs are always cheaper or always must be cheaper. I mean, we want to be cost competitive, you know, we at Sonoma Clean Power, but there might be times when we choose to not be cheaper than PG&E and to instead use that money for an electric vehicle incentive program or to buy more renewables that are required by law. But that dynamic certainly does exist. Customers could go back and, you know, again, I think this is the benefit of competition, and it really should benefit everyone in the end.
Yeah, and that would be a good reason that folks are going back to the investor-owned utility procurement rather than community choice program doing anything wrong. I mean, I think we would be fine with the competition driving both entities to improve and overall ratepayers benefit, and that choice is there. It should be real, and we're hoping it will motivate the investor-owned utilities to continue to improve their practices and have incentive to continue to drive prices down, and hopefully the regulatory processes will lead to more and better procurement, better cost savings for ratepayers in the procurement in the regulated realm.
All right. Well, look, I think we probably have time for maybe one more quick one, if there is one. Ross, do you have another question?
Let's see. Well, we had a question about the report asked by Jeff Byron, asking if Cal CCA or any of the CCE agencies endorse the report, and will it be filed as part of the CPUC rulemaking on PCIA?
So far, it's a report of the Center for Climate Protection. We're happy to share it with any entities that would like it, and if it's of use, and we were hoping it is of use for folks, and we'd be happy to make it available. And you can contact the Center for Climate Protection if you want to get their permission for utilizing it further.
Yeah, I think I think that's a great question, and we will certainly take that to the upper echelons of decision making here at the Center for Climate Protection. So I do want to thank everybody for attending today. Thank our presenters. I'm really glad that I attended this webinar. I learned a few things, and I think it was very, very interesting, and some great questions coming in there. And so I think one of the main things that is obvious here is that this is complex and an ongoing conversation. So the two places that I'd like to invite people to continue the conversation, one is our own Clean Power Exchange forum that we've just fired up. So that's available there. We look forward to hearing your comments, questions, and concerns there, and we will be probably using some of the questions that came in today as some of the topic areas in that forum. Also, too, as has been mentioned earlier, there's an active proceeding. Folks that really want to dive into it can become an intervener and get some intervener compensation, but you can subscribe to the proceeding to get all the information at that URL, and that's the rulemaking number there. I do want to invite people to our next webinar. We'll be on Wednesday, September 20th from noon to 1, Beyond Combustion, Electric Vehicles and Community Choice Energy, a Sonoma County case study. The report, this is another webinar revolving around a report by the Center for Climate Protection authored by Duran Amaran, our Center for Climate Protection staff, and we will have Cordell Stillman, who is in charge of the Drive Evergreen program that Neil mentioned earlier. So again, thanks to all who have participated today, our presenters. Ross, thanks for being there for the questions. Neil and June and all of our participants. We did have about 100 people on board today, so really happy to have such great turnout. And so with that, this webinar comes to a conclusion. Thanks all for joining us.